If you had $10,000 today and no financial foundation, the way you choose to invest, it could set the direction of your entire financial future. Most people think investing is about finding the perfect stock, the next big cryptocurrency, or some secret opportunity that will turn a small amount of money into life-changing wealth over. But in reality, long-term wealth is built through structure, balance, and discipline rather than guesswork or luck. Before we go deeper, I want to ask you something simple. If you had $10,000 right now, would you invest it all at once? Or would you wait for the perfect time? Think about your answer carefully, because this decision alone reveals a lot about your investing mindset. The first thing I would do is avoid investing the entire $10,000 immediately. One of the biggest mistakes beginners make is believing that money should always be fully deployed into the market as quickly as possible. In reality, having liquidity is just as important as having investments. If I were starting from scratch, I would keep a portion of the money, around 20 to 30%, as cash or in a highly liquid savings option. This serves as a financial buffer and also gives you flexibility to take advantage of opportunities when they appear. Markets do not move in a straight line, and having cash available allows you to act when others are forced to react emotionally. Now, here is something important to understand. Money that is not invested is not wasted if it serves a purpose. Liquidity is a strategic advantage, especially in uncertain economic conditions. It prevents forced selling, reduces stress, and gives you control over timing. After securing liquidity, I would allocate the largest portion of the remaining money into long-term, stable investments. Around 40 to 50% of the total capital would go into diversified index funds or broad market ETFs. The reason for this is simple. Most individual investors do not consistently outperform the overall market over long periods of time. Instead of trying to predict which companies will succeed, index investing allows you to own a small portion of many companies at once. This reduces risk while still allowing you to benefit from overall economic growth. Now pause for a moment and consider this. Would you rather try to guess one winning company or invest in hundreds of companies that collectively grow over time? The answer may seem obvious, but many beginners still take unnecessary risks trying to beat the market instead of participating. The next allocation would be to higher growth opportunities. Around 15 to 20% of the portfolio would go into sectors that have strong long-term potential but also higher volatility. In 2026, areas such as artificial intelligence, automation, cloud infrastructure, and digital technologies are reshaping global industries. These sectors are growing quickly, but they also come with risk. The goal here is not to gamble, but to strategically expose a portion of your capital to innovation and future growth trends, while keeping the majority in stable investments. Another portion, roughly 10 to 15%, would be dedicated to personal skill development and self-investment. This is one of the most overlooked but powerful forms of investing. Learning high-value skills such as digital marketing, coding, sales, business development, or AI-related tools can significantly increase your earning potential. Unlike traditional investments, the return on skill development is not just financial growth in your portfolio, but also increased income capacity for the rest of it. In many cases, improving your skills can generate higher returns than any market investment. At this point, many people expect a get-rich-quick allocation, but that is not how sustainable wealth is built. I would avoid putting large amounts into highly speculative assets like meme coins, hype-driven investments, or single risky stocks. While these can sometimes produce short-term gains, they also carry a high risk of significant loss. The goal of a $10,000 starting strategy is not to gamble, but to build a foundation that can grow consistently over time. Real estate is another area people often consider, but with $10,000 alone, direct property ownership is not practical in most cases. Instead, exposure to real estate through REITs or real estate investment funds would be a more realistic approach. This allows participation in real estate markets without requiring large upfront capital or dealing with property management complexities. Now let's talk about the most important principle in this entire strategy: diversification. Another key factor is time. Many beginners feel confident when markets are rising, but panic when markets fall. This emotional reaction often leads to poor decisions, such as buying at high prices and selling during downturns. A well-structured investment plan should be something you can stick to even during uncertain, disciplined, and aligned with long-term thinking. Before we move on, I want you to reflect on this question. If you had to choose only one area to improve first, saving discipline, investing knowledge or income growth? Which one would make the biggest difference in your financial life right now?